Hi there, traders. Now, I've got a good question here from Michael regarding last week's trading and following the non-farm payroll. So I thought I'd quickly do a video. It's easier than me typing out War and Peace. Hi, Brad. I was wondering why the market was so indecisive with such bullish non-farm payroll figures last Friday. Was it because of the bearish sentiment trade dollar figure or the US stimulus package? Well, it could be, the stimulus package could be a part of it, right? The fact that that is coming out and the impact of that is, it's going to generate employment, etc. There's a few other peripheral things, but right now, understand what's happening. There's two things that happened last week. Fed Chairman Powell came out and was talking about they're going to let yields continue higher until they get maximum employment, right? So to me, the US Treasury, right, the US Treasury yield high or increase, especially just focusing on the 10-year, it's gone from 1.4, went up to 1.6. It's, where is it now? It's somewhere around, should tell us, 1.587. So it's still there, right? And it's been slowly going up. So the Fed have told us they're not going to do anything about the yields and that makes the US dollar extremely appealing to local and international investors. They'll go in for that yield, right? Now, when it comes down to the Fed, they're saying, well, they're not going to do anything about that until they get maximum employment. So what happened was we had a situation where, weaker non-farm payrolls would have been better and we would have seen a bit more of a consistent move higher in the yields because a good non-farm payroll number comes back into exactly what the Fed was saying. It comes back to them potentially coming in and doing something about the bond yields. Okay, whether they start buying bonds themselves and pushing those yields back down, right, makes it a little bit less appealing, and that's where things can change. So it's very hard. Well, not very hard. It takes a bit of experience to understand the dynamics of what the market is looking at very closely. Now, they are watching what the Fed says. This non-farm payroll number, it was a great number. Average earnings was pretty good. The unemployment rate, even better. So yeah, you would think the dollar would rally through the roof, but the move in the dollar is coming on the back of the treasury yields, right? So the fact is the central bank has told us if these numbers get really good, they're going to stop that yield going up, right? And so that's why the dollar, in my view, really stalled and didn't go on with it. So when you're looking at your charts, you think, well, wow, normal market conditions, those sort of non-farm payrolls, this thing goes up 100 points. So let me just change the color of that so you can see it. But we saw a little spike higher there in the dollar index and it stalled, right? This is because the initial number, you get that move in the dollar, but then they come back and put it into the equation of the market mechanics of right now. What does that mean for the treasury yields? What does that mean the central bank, the Federal Reserve, is going to do about those yields? If we get another non-farm employment number like this next month, well, you know what? They're going to step into start buying bonds. The treasury yields will go down, okay? Price of bonds will go up, and the dollar, the real appealing part of the dollar right now, will be diminished, right? So that's what's happening right there at the moment. And so we're just going to wait and see. The market will, I don't think it's one number on its own isn't enough to stop this, but you get two numbers and connecting numbers like this week's CPI numbers, well, then you know what? We could see the end of that, this rally in the yields on the US treasuries, right? And that will take away the appeal of the US dollar internationally, and we should see the dollar drift lower. So to me, it's almost like we would like to see these sort of mediocre economic conditions continue, because then we have the easy lead in. When you get direction, you nail it, as in you really stick with it and focus on it until something comes out which is going to impact that direction. And that's what the non-farm payrolls did to what the Federal Reserve said, I think it was on Thursday. And that's the way you got to roll with it. So connect the dots, and nice little sort of bounce back here in the equity markets on Friday. Probably part and parcel to that situation where the Fed may have to come in and start doing something on the yields, because you know what, the numbers they were just talking about have started to come back into play already. All right, hopefully that answers your question. A little bit confusing, I know, for some that don't understand the dynamics of the market, but this is exactly what's happening at the moment.